The Royal Swedish Academy of Sciences has today decided to award Sveriges Riksbanksprize in Economic Sciences in memory of Alfred Nobel for 2022 to Ben Bernanke, the Brookings Institution, Washington, D.C., USA, Douglas Diamond, Washington University University of Chicago, USA, and Philip Dybvig at Washington University in St. Louis, USA. They obtained the prize for research on banks and financial crises. Professor Tore Ellingsen will now give us a short summary of the field. Please.
We didn't know it at the time, but 15 years ago, much of the world stood at the brink of a devastating economic crisis. Most of us were unprepared for it. However, a few academic economists were both prepared and worried. They had studied the theory of bank runs. They believed the evidence in its favor, and they suspected that the possibility of runs was yet again becoming relevant. As events unfolded in 2008, 9, and 10, new evidence piled up in favor of the theory. In a nutshell, the theory says that banks can be tremendously useful, but they are only guaranteed to be stable if they are properly regulated.
So Ben Bernanke, in a paper from 1983, showed with statistical analysis and historical sources that bank runs led to bank failures. And this was the mechanism that turned a relatively ordinary recession into the depression in the 30s. So he showed that banks need to be there. They need to be up and running for the economy to work. And if they don't, then the economy works worse, much worse. At the time when Bernanke published this, this was a break with the current views. Of course, people had seen that banks failed, but it was more thought as a consequence of the crisis rather than a cause of the crisis. But now, the views of Bernanke have become the conventional wisdom. Diamond and Dybvig, in a paper in 1983, showed that banks are perfectly constructed to make sure that savings are transferred to productive investments. They do that by stepping in as an intermediary, a middleman, solving a quite natural conflict between savers and borrowers. So banks step in by doing what is called maturity transformation. What they also show in this paper is that this maturity transformation is inherently vulnerable. If a rumor starts that people are going to take out their money from the bank, then everyone has an incentive to rush to the bank to take out money in time and not come last in line for taking out the money. And this can create failing banks. And this is something that's inherent in the maturity transformation. So maturity transformation is important, but it's also vulnerable. So what's the importance of all this for society? Well, as I said, the laureates have provided the foundation for our modern understanding of why banks are needed, why they are vulnerable, and what to do about it. So in the laureates' work, it's shown that deposit insurance is a way of short-circuiting the dynamic behind bank runs. So with deposit insurance, there is no need to run to the bank, and bank runs don't really need to start. They also show that liquidity provision, lending of last resort from the central bank is a way of dealing with this. So the ideas that we today recognize have proven to be invaluable also in modern times. During, for example, the financial crisis, when the laureates' work were turned out to be important to understand what was the cause of the crisis. So society is changing, and financial markets too. New agents come up, new financial instruments come up all the time. But the need to construct rules and understand the financial markets in order to reduce the risk of financial crisis and to prevent them into turning into depression, that need really remains a first-order priority. And the laureate's work, despite being actually 40 years old, still remains an important ingredient in that endeavor.